Welcome to the podcast series, You've Been Granted, hosted by Brian McDonald, CEO and founder of Granted. Today's guest is Joe Pancamo, Principal of Global Employer Services at BDO. Joe helps multinational companies navigate the complexities of employment, enhancing employee welfare, and driving engagement and productivity. We hope you enjoy this conversation. And now, Brian, over to you.
Guess I should say thanks, Corrine. That's Corrine Snyder who did the opening for us. But welcome, Joe. How are you?
Doing all right. How about yourself?
Yeah, great. Welcome to the You've Been Granted podcast. I know that it's been your lifelong dream to be part of this podcast, and so I'm certainly happy to have you here today. For those of you that haven't met Joe, Joe is the Principal and Global Mobility and Equity Tax Solutions Leader at BDO USA. We all know BDO. He's been helping companies navigate the complexity of equity compensation, taxation, global mobility for over 15 years. I think that makes it, probably the most significant part of your career, Joe. But welcome to You've Been Granted.
I appreciate it, Brian. I'm excited to have the conversation. I'm sure we'll cover a lot. It's great to be on.
Yeah, it's great to have you. I'm in Denver, Colorado, downtown Denver today. Where are you calling in from?
Dallas, Texas, and I'll tell you, summer is here, so we're not complaining.
That's great. Well, I don't know if that's good or bad, because summer is here in February is probably not what many of our listeners would be expecting you to say.
But you know what happens come June, July timeframe, we start to head your way.
Well, and it's funny because Denver is probably in the 60s today too, which is fortunate if you want to go outside and go for a run, walk the dog, but it's not so great in the mountains. We've had a really bad year from a snow standpoint, and for those of us who are avid skiers, we would like to get a few more runs in this year. So maybe we'll get that late spring snow.
Fingers crossed for you.
Thank you. All right, so we're just jump right into it. Your journey has been not linear. You've done a bunch of different things, but tell us about your journey in equity comp, and the mobility tax area is certainly your expertise. What drew you to this specialized area, and how has that evolved? Not only for you personally, Joe, but how's it evolved at BDO over the last several years since 2010?
Sure. Yeah, and I'll tell you, I started my career in the banking industry and foundationally grew into relationship building, and quickly found myself in accounting. When I came to BDO in 2010, I was immediately exposed to real world issues that companies were facing, and especially as they're dealing with employees moving across borders. And one thing led to the next, and you went from mobility taxation to compensation, and where the two overlap. And you can imagine you start getting into the complexities around strategy and payroll, HR operations, and tax. One thing goes on to the next, and it's just one complication after the other. So I tell you, I'm really excited about what I do day in and day out. It's like fitting a puzzle piece together. You're working with so many different stakeholders, and you're just there to get it right and help them thrive in their day to day.
Yeah, that's great. And we've spent a lot of time with issuers over the years, and problem solving is a big part of the role of not only BDO but record keepers. What we're doing at Granted. It's interesting because even though a lot of plans look alike, and a lot of things are consistent and standard in the industry, each plan, each person, each individual's needs are unique, and so problem solving is a big part of that. So it's glad to hear. I'm glad to hear you say that. So for those of us on the screen that know you, we know, but for those of you that don't know BDO, and I'm trying to use your little bit of your commercial cheekiness there, but for listeners who may not be familiar with BDO's practice, what does Global Employer Services mean in practical terms?
Yeah, so I'll tell you, I appreciate the question. In practical terms, when you're thinking about Global Employer Services, this is where employers go when they're asking, we have people working in multiple places. How do we pay them correctly? Are we withholding correctly? Are we compliant? And we want to make sure that our employees have an enjoyable experience. We don't want to deal with the questions. We don't want to get to the position where something doesn't seem right. And at the same time of making sure that we're compliant in what we do, we've got this nagging question in the back of our head. Are our compensation and incentive structures, are they the right structures in place to attract and retain talent? So if you start thinking about, again, getting back to some of those complexities, you've got a global environment, people running around the world. There's a lot that comes into play.
Yeah, that makes sense. And maybe just for the listeners, who are your clients? Are they private companies, public companies? And, who are you working with on a regular basis? And what's keeping them up at night as it relates to equity compensation?
Yeah, I'll tell you, our typical client is the multinational. It's fast growing. They're expanding internationally. They're looking at meaningful incentive programs. They might be public, they might be private, but they're growing and they're moving quick. And some of the things that keep them up at night is, as a business, we're not entirely sure. We're in this position that we just don't know what we don't know. We're expanding rapidly. We need someone to be in our corner and help us plan for that growth. That one advisor that's looking around the corner and thinking, so-and-so or such and such is coming down the path, be thinking about how to get this done correctly. And then from a people and compensation perspective, as the company grows and becomes more complex, these questions around being compliant really start to expand. We're talking about multiple levels, multiple jurisdictions, federal, state, international. And do we know where our people are? We have a global workforce. We're not entirely sure that we know where they're performing services from. Lines of business are starting to make decisions, through their own path, but maybe things aren't really being checked or, being, I would say, run up the chain to make sure that as the business is moving forward, it's done in a compliant way. And to that extent, we have expansion on service providers. So our service providers aligned. The payroll department, the equity department, the mobility department, is everyone reading from the same page. And I would say, lastly, if we were to be audited, if an auditor were to walk in and say, show us your work, could we do that? Could we defend the position? That's what clients come to us for.
Yeah. I mean, reliability, accuracy, all of those things, I think are probably not, they're must-haves. They're not like negotiables. Those are things that you need each and every time, each and every client. So that has to be a consistent part of your practice. I'm going to take us through 4 different sections. So the way I thought about our time together and some of the questions is to break them into 4 different sections where we can get a little bit deeper than the surface on some key topics. And we'll start with section 1 on U.S. equity compensation landscape. So what's going on in the U.S.? Because I know that you think about the world, not just the U.S. But we'll do a little bit like Jeopardy. So let's do we'll pick tax compliance and withholding for 200 to start. How about that?
That sounds great. That's our bread and butter.
Yeah, right. So let's start with some of the fundamentals. Like, what are the most common mistakes you see companies making with equity compensation, tax withholding in the U.S.? So it's a big part of what everybody thinks about, and it's state by state, jurisdiction by jurisdiction. But what are some of the common mistakes you see happen?
Well, I'll tell you, the most common mistakes is sit back and think about it. It's less about knowing the rules or not knowing the rules. These days it's more about a breakdown in the systems and the teams. Too often, a lot of what has to happen to get this thing right gets bifurcated and siloed, and that's one of the biggest mistakes that we start to see. Equity compensation, especially global equity compensation, it's a really heavy handoff process. So you have the equity admin platform, you've got your broker, payroll, HR, mobility, tax. Everyone owns a piece. And when things start to fall apart or not work, together, you get these gaps and the issues that fall in the seams. That's where you start to have real big problems.
You do a little bit of writing, blogging, whatever we want to call it today. But you recently wrote about non-resident alien withholding rights, way above my pay grade. But can you explain why this is such a common area of confusion, and what are the consequences when companies get this wrong?
Great question. The issue we run into is that payroll, the systems, the way they're set up, looking for that silver bullet or that one size fits all. And when you get into mobility and you get to non-resident aliens specifically, there's not a one size fits all answer here. Immigration status, tax residency, treaty positions, income sourcing, these are all complicated factors that just don't show up neatly in a payroll file. Right. So when you have these one-off cases, pulling them off the shelf or pulling them out of the rank and saying, we really need to, kind of home in on this. Are we doing it the right way? That often gets missed.
Yeah. What are the consequences of that? Have you any horror stories you've seen that you, not the names, of course, but anything that you care to share in terms of consequences?
Sure. I mean, the consequences are real. On the employer side, tax exposure, penalties, interest, control issues. When you look at the tax aspect, what they should have withheld, the IRS can come in and say, whatever the amount of withholding was or should have been, now that's on you. We're coming after you. Where are your people? What are their status? That is the employer's obligation to get right. So there's some major consequences on the employer side of it. On the employee side, surprise withholding or a surprise tax due or a past due tax bill, that becomes a huge employee experience issue. And you start to erode at the confidence factor. And employees will start to think, maybe I should take my career somewhere else.
Yeah, I mean that worst case scenario, right? And as we know, equity comp is the biggest incentive to help attract and retain talent. You brought it up earlier, and so anything that starts to erode that trust actually kind of devalues what companies are trying to accomplish.
Yeah, and kind of getting up to the end of the year, you really want to get it right. Nobody wants to be dealing with unwinding and doing corrections in Q1 when you probably have 10 other things going on. So the last thing you want to do is try and go back and do retroactive corrections.
Completely agree. At Granted, we work with a lot of companies, both private and public. And on the private side, we know that many employers are pushing the limits in terms of equity plans and various instruments, and it's actually kind of fun. I mean, we actually get more excited about the more complex issues. We try to help make those simple. So we see that as a challenge. But at the company level, how do tax compliance challenges differ between public and private? Especially when you think about equity compensation. So 409A valuations, liquidity concerns. How are they different, and what's that complexity like on the private company level?
Yeah, so it's really interesting, especially, I've had the opportunity to see a lot of private companies become public and challenges and issues that they run into. Watching that transition and being there to support them, it's been a really interesting experience for me. But I'll tell you, public companies, usually they have more infrastructure and more standardized in place, broker feeds, payroll integrations, internal controls, but they also have scale. So small errors can become big dollar errors really fast. And then to contrast that, if you think about private companies, they've got a different set of challenges. And one of the biggest ones is around liquidity. Public companies, their employees, they have a market. They could do some selling of shares to cover taxes. Private companies, that open market isn't necessarily there. So, some questions you might get on the private side is, how do we withhold, and there's no cash coming in? We need to help our employees settle some of these transactions. There just isn't that open market to do it. Then you bring up 409A, another factor here on the private side, but it matters a lot because it truly influences the strike price. It can have some downstream tax effects and some really, really, really nasty penalties that you really just don't want to see show up. But documentation needs to be solid.
Yeah, makes total sense. And then from that perspective, we have 75 or so companies that are going public maybe this year. I'm sure the list is longer, but there are 75 big ones that have come up. And going from private to public, like you said, is a big event. It's a big important event in a company's life, maybe the most important event. And getting these things right ahead of those events, I think is incredibly important. especially as you're shifting the cap table, maybe cleaning some things up, maybe you're doing, you know, some sort of tender or auction to kind of get things in order. But you know, how do you, you know, what recommendations do you have, I guess, for those who are leading equity plans on how they go through that process, you know, thinking about what you just mentioned in terms of not only 409A, but just a lot of those liquidity needs that they're thinking about?
Yeah, so I would say plan ahead and be thinking about making sure you've got the proper scale, you know, plan for scale, and you've got the right documentation in place, and you know, work with a good equity administrator or have the right platforms, because some of the challenges on the company side, I mean, they're not the same challenges that the employees as an individual are going to face. So planning ahead and documenting and making sure everything is aligned is really key to having a successful program.
Yeah, makes total sense. For financial advisors, because a big part of what we've built at Granted is a tool, a platform, more than just a tool, but a platform where they can, you know, keep track of their clients who have equity compensation, almost like a, you know, a personal record keeper at the financial advisor level. It has alerts and everything to kind of keep them in tune with what's going on, vesting events, you know, expiration events, and then also, you know, building trading strategies and staying in tune with those trading strategies, including 10b5-1s for their clients along the way. But for the financial advisors that are listening, can you give us a quick primer on, you know, the major types of equity compensation and their tax treatments? You know, what should advisors know about ISOs and non-quals, and how are they different versus RSUs from a tax perspective? Like, what's the little cheat sheet or cheat code that you would give financial advisors?
Yeah, so maybe I take this from maybe order of least complexity to most complexity, and people may agree or disagree with me, but we start with RSUs, and most people will just keep it simple in the sense that it's taxable at vest. You got ordinary income. It's in your W-2. There's withholding. That's all there is to it. After the fact, you've got some capital gain or loss when you sell. Probably the most streamlined approach.
Right.
You move on to non-qualified stock options. Well, now you have an exercise. You have a strike price. You know, you're exercising your option to purchase shares. You've got to calculate a spread. That's in your W-2. There's withholding as well. And then we're waiting for future appreciation. Hopefully there's a capital gain and not a loss. So an added layer to RSUs. And then I would say the ISO construct, this one can be really challenging because first and foremost, let's start off with the fact that it's a U.S. construct. And if you have mobile employees, ISOs don't play really nicely with other country tax rules. And there's some really specific rules in the U.S. to qualify for the special tax treatment around, you know, 2 years from a grant date, 1 year from an exercise date, to capitalize on the purpose of having an ISO. So it's probably, you know, getting down to the path of having an ISO, and I'm not even getting into the real, you know, complicated tax aspects of AMT, alternative minimum tax, and how you have to calculate your taxes in an alternate arrangement. But scaling from RSUs to ISOs really takes a sophisticated program manager in place to get that right. And layering on the mobility complexity just adds another component.
Yeah, I mean, what we're seeing a lot, and you know, from our clients, especially financial advisors, that you know, they've asked us to build, and we've built and launched recently. One is the RSU analyzer. Again, as you mentioned, they're straightforward, but one of the challenges that we see a lot is are their clients are being under withheld, and it's really not under withheld. They're being withheld properly, but it probably, because of the statutory rate, is different than maybe their true tax rate. So they get to the end of the year, they go to do their taxes, and they have this big, you know, big bill they have to pay. And if they don't reserve for it, or if they didn't sell enough shares, then, you know, that could be a problem. So we try to help them kind of understand what that potential tax gap is going to be, so that they can give their clients better advice on how to reserve for it. And, you know, the other thing you mentioned around ISOs, I mean, you see that mostly, obviously, with private companies. It's still widely used there, and the AMT piece of that is real, especially if you have to strike your options and, you know, put cash in to cover the taxes. And then, you know, if you do have the AMT, the carry forward piece of that is often missed. And so we try to make that as easy as possible for advisors to understand and advise on in the platform. But you're right. It can be more complicated, and the RSU plans are probably the most easy to understand. The other thing though, where that takes me is kind of, what are the trends you're seeing in terms of how plans are being structured? Do you see that in 2026 or even in 2025? What type of awards are the most popular, and how are they being perceived by plan administrators and those that are doing the plan design?
Sure. Yeah, I'll tell you some of the trends that we're seeing last year, and it seems to be this way going into this year as well. Simplicity and predictability. So, along those lines, RSUs remain popular. They're straightforward. They're easy to communicate. They're easy to administer, especially for larger groups. We do a lot of work for clients that have a mix of all forms of awards. RSUs by far seem to be in favor because you can plan for that. The stock options or the ISOs, there's less predictability. They're less favored. We're also seeing performance and retention features, and more performance-based equity for leadership and key roles, and more attention to how those rewards are actually driven. How they drive and how they get retention in place. They lock that feature in. And then private company liquidity planning. I'll tell you, this was a trend closing out last year. More structured secondary programs and tender offers. I think companies know that employees are struggling with paper wealth. So, the paper wealth aspect and how to plan around that is starting to push some of these trends. And let me think for a second. Maybe around global ready plan design. Again, getting back to simplicity and predictability. But as companies start to structure equity programs and expand, they want to make sure they have a plan in place that's not going to fall apart the minute they have employees in multiple countries.
Yeah, totally makes sense. And, we're seeing some of that, especially on the liquidity side, as you mentioned. Private companies are staying private, 12, 14 years. Again, I mentioned, seems like a lot of companies may be coming out this year, and it will be fun to watch in 2026 on the IPO market. But more regular tenders, whether it's every 6 months or just more regular tenders, providing liquidity to the employees, across the board. But the ability to be able to use that to plan to buy houses, to reinvest in the market, to pay for college education, whatever it might be. I think the tender offer solutions are a perfect way for private companies anyway to provide liquidity. All right, so we're going to go. Section 2 is our probably my favorite section. Technology and equity compensation is certainly at the heart of what we're doing at Granted. I'll ask a few different questions in here. I'm sure I'm going to have an AI question in here, so you can get your spidey senses going on your response. But this has been a big part of who you are, Joe, and what you've been able to accomplish with and for BDO. But you've been instrumental in developing, especially their global equity mobility solution. And that's actually an acronym of GEMS that you guys use. But what problem were you trying to solve when you set out to build this platform? And is it meeting the needs of the industry today?
Yeah, no, I appreciate the question. The problem that we were solving for was the classic global equity meets global mobility. The data that companies need is scattered. And by the time they realize what's missing, it's too late. It's already too late. So, to get the equity calculations correct, reporting across multiple jurisdictions, and the withholding accurate as well, there's several components that go into this mix. And a lot of it's around the equity comp itself, getting the right dates, grant dates, vest dates, exercise dates, payroll data, year-to-date compensation. Social Security issues seem to really trip companies up. Work location history, assignment dates are also a big component to this. And, that's just the core component. We haven't even gotten to, well, how's this taxed in this country? How's it taxed in that country? So all the input aspects that go into the calculation, but then the rules layered on top, country by country. So GEMS was built to bring those streams together and really get to an automated approach to income sourcing, consistent withholding, and allowing companies to have a defensible audit trail. If you're ever in a payroll audit and the question comes up, how'd you come up with these numbers? Well, I've got some detailed, sophisticated calculations to help back up my results. So you want to get this done in an efficient manner without, flying in at the end of the day and having some kind of heroics to save the day. This is why we brought the tool to life.
Yeah, I mean, heroics are not good. And, I used to say when I was you're running Morgan Stanley at work, and even in my past life at Schwab, like, we don't want stock plan emergencies. There are those, but we try to avoid them. From your vantage point, Joe, like, how has technology changed? I mean, especially over the past, I'd say your 15 years, but even the last decade or even 5 years, how has it changed? And, are there still places where we're using manual work today where you see that, where you think that could be automated, and maybe AI is the answer for some of that?
Sure. Yeah. I mean, technology has absolutely improved. If I just think 10 years ago, even getting a clean file from your brokerage system could be a painful event. Now things have become more automated. We still have some challenges. There's still some outdated aspects to what we do in the tech world that I'm sure are really hard to standardize, as we're all starting to find. But the work location tracking, day counts for income sourcing, shadow payroll coordination, multi-state cross-border tax reconciliation, and my favorite, the exception handling. When someone moved from one location to the next mid-vesting period and it doesn't fit that perfect model, maybe they went on leave or they changed their residency, how do you pull that one out of the rank and file and deal with it? That's something that tech and AI is not currently placed to help. I say to my clients often, it's like, do you want an automated solution where you're trying to set certain defaults, or are you looking for those exception cases? And often you have to plan for both. Right. So we're getting better. We're better at the happy path, but we're still struggling with how to deal with the real life issues.
Yeah, it makes total sense. And, maybe a throwaway question, but I'm sure they got appreciably harder, or the volume went up during COVID. But did it go up as a spike during COVID, and has it come back down since? Or, what have you seen, especially from a mobility standpoint?
I'll tell you what COVID brought on. So a huge increase in remote work, but we also had some of those stealth remote work employees. So created in a lot of ways challenges, nightmares for HR, really getting the sense of we need to know where our people are. We had a lot of those situations where individuals quietly exited higher taxing states for low tax or no tax states, and give it some time, it comes to be, and the employers had some backtracking and retroactive adjustments to make.
Yeah, maybe we should, as HR professionals or equity professionals, should make you give us your Airbnb app, so we know where you're going to be in the future.
Well, that's all these technologies started coming out around GPS tracking and counter tracking, know where people are, and you run into a host of other issues with that too.
That was the big joke about people having burner phones in New York, right? Like, that's right. So granted, you and I have spent a little bit of time talking about the platform and what we're doing, but we're focused on helping financial advisors, but also the award recipients themselves make better decisions on their equity compensation. What to sell, when to sell it, at what price, how to think about it in a tax optimized way so you get the most out of your grant. And really, if I have to step back, our mission is elevating the conversation between the companies issuing equity, the individuals that they spend so much time trying to attract and retain, who receive those awards, and then the financial advisors that serve them. And one of the things that keeps us up at night, and we have an advisor platform, and soon in April launching an issuer platform for their individuals, trying to help those individuals who negotiated probably so hard for equity compensation, but get to a place where they're super concentrated and may not even know what they own or how to make sense of it. And we're trying to make that simpler. And again, when they're ready for advice, bringing the advisor who really understands how to help them to the table to help them. But, from your perspective, corporate HR teams that are managing grants and trying to help these individuals better try to understand what their own, what advice would you give to them, or what recommendations do you have?
Yeah, I mean, education is a big factor around this, and hitting the nail on the head with what you just said. I'm really appreciative that you guys have that offering, is because from the employee experience, employees experience equity as, what do I have? What is it worth? What do I do? What's the tax impact? Corporate systems traditionally are built for compliance and reporting. They're not built for the individualized education and decisions.
Right.
So, we see those gaps in the basic understanding of what they own, and the modeling, the scenarios. What happens if I exercise, sell, hold, and then helping them interpret the forms, W-2s and 1099s, and trying to understand what the base, what's my true basis here. And I'm working with my tax advisor, and none of these forms seem to map up. So education is a key part to it.
Yeah, I think so too. I mean, and you can almost never have too much. I mean, it needs to be consistent, but the individual HR teams, the record keepers who do a great job of providing education, and then sometimes there's a need for something that's more personalized, just for the individual, and that's one of the gaps that we're trying to help advisors, but also the companies who issue equity, to close that gap. So let's jump into section 3, which is we'll do section 3 for 300. The role of financial advisors and tax advisors, staying on that theme of the individual, advisor blind spots, whether it's tax advisors or financial advisors. In your experience, how well do most financial advisors understand equity compensation, and what gaps do you see there?
So I'll tell you, some advisors are excellent at this, but broadly, there are gaps, and they're predictable. And much of that is around just the confusion aspect of what's the taxable event, potentially underestimating the impact that AMT might have when you're dealing with ISOs, and then not appreciating how often state income sourcing changes the answer, especially for remote work. We saw a lot. We'll go back to COVID for a second. I mean, we saw a lot of New York to Florida, California to Texas. Then there's a taxable event, and the employee is not planning for the fact that those states are going to claw back. They're going to look to claw back some amount of the income based on the time in those states, and sometimes that's underestimated.
Yeah, we spend a lot of time with financial advisors. Some of with the enterprise, wealth management firms, and sometimes it's a 1 or 2 person RIA that is using our platform. And the other day I had an advisor say to me, well, I just don't have that much equity compensation in my practice. I only have one person that I'm working with today. And I said, well, how big is your practice? And he was like, it's about 100 clients. And I said, have you reached out to them? Do you know where they're working, public or private companies? And is equity a part of their of what they're doing? And, after a couple of weeks where he had sent some emails out to his clients asking about their equity comp, lo and behold, he came back and said, I had 25 people respond to me saying that equity comp is a big part of their financial concerns, and they hadn't been engaging on it. So I think sometimes just asking the question, and I think advisors miss the chance to just really understand if a client's working at a public company or a private company, where they're getting equity, and do they feel like they're on their own with that, or how do they engage him or her to talk about that? But so that's one of the big gaps we're seeing. Any thoughts on your part on like what questions the advisors should be asking their clients? Is it as simple as like, hey, do you have equity comp, or is it more detailed that you think they should go?
I think if they could dig in, I would love to hear advisors ask more consistently, at least. What type of awards do you have? Do you understand the dates? What are the key dates? Have you moved, the point you made earlier, like you moved states? Have you moved countries during the vesting period? What's your company's withholding method? Does it cover your marginal tax rate? I mean, companies, they're obligated to withhold at, let's say, a supplemental rate. That rate is 22%. Okay, maybe they're covering their obligation. If your tax rate is closer to 30%, well, I'd like to see advisors have some conversations around the potential of making estimated tax payments, as an example. And then we could always look at the AMT concept again. Has this been an impact before? Are there any credits that we should think about moving forward? And do you have all your transaction statements, all the supplementals that go along with it? I think if they ask some of these questions, you'll start to uncover 80% of the problems.
Yeah, I love that. I'll play an either or question with you. I think the answer is probably both, but if you had to start as an individual with a complicated equity compensation question or need, would you start with a financial advisor or a tax advisor?
That's a great question. I want my financial advisor. I want my tax advisor. I want my lawyer in the room as well.
Right.
These documents are complicated to understand. So yeah, you need an army in your corner.
I think the answer is likely going to be both. And I think collaboration between the two is great. I mean, personally, my financial advisor, and yes, I have one too, and my tax advisor are in sync. Like, document sharing process and just communication is really strong. And so that's a recommendation I would have for financial advisors, but also for individuals that need both.
Agreed.
So one last one, when an employee leaves a company with unvested equity or unexercised options, what information should they be taking with them to their financial advisor or tax preparer, especially, if they have that 90-day shot clock on some of these things?
Yeah, that's a great question. And when I'm advising individuals on here's what's coming, what should I plan for? I like to call it my personal equity data package. Like, assemble your award agreements. These documents have the key terms, expiration dates, post-termination exercise window, have their full transaction history on hand. Of course, you're going to get your W-2s and 1099s in the mail. You want to know that you have someone back at your company, it's HR services or what have you, that if something comes up, what's the key contact what's the key contact information to get any questions answered. And then if you've moved, make sure you've got some tracking on your timeline. And I think assembling this package will save you hours and prevents a lot of mistakes.
That's super helpful. And, taxes, we don't want them to be gotchas. We want to plan for them. We want to be smart about them. We want to optimize them. They're a reality in life, and we know they're coming. I think we reduce stress if we have a better plan. So I love what you said there. All right. So section 4, we're going to do the artificial intelligence and automation for 400. And, seems apropos relative to everything that's going on. I mean, there's been some big announcements this week where, Claude put out co-work, which I think is doing some amazing things. You can now build spreadsheets and PowerPoints with Claude. There's been a lot about this Claude bot, or I'm probably getting that wrong, Claude bot. I think it's changed its name a couple of different times. And then Altruist announced something where they can read a tax statement and come up with recommendations for clients. So it's going to continue to push the envelope here. So where are you seeing artificial intelligence play the biggest role today in equity compensation, especially with tax compliance side of things?
I'll tell you right now, I'm seeing AI to be the most helpful in the parts of our business or the areas where it used to require just full-on brute force, just the hours. And that's reading and extracting information from documents, normalizing messy data files, or flagging mismatches and exceptions, speeding up triage, which is, homing in on here's something that's not quite what you would expect it to be. So there are areas that it's been extremely helpful, and it's been those areas where it's just, you have to roll up your sleeves and dig in.
Yeah, I mean, I think that's super helpful. And then even whether it's either a tax professional or an individual using an LLM today, doesn't matter which one. How ready do you think they are to answer tax questions? Like, if I just throw something today into ChatGPT or Claude about my personal taxes, how much can I rely on the answer to those questions today?
Yeah, I'll tell you what I've appreciated about it is just running down the scenarios and really prompting the thought process. Anything that comes out from my experience, you're going to want to verify. I don't think we're there yet where we could just say,
what does that look like? How do I verify as an individual?
You're going to want to have those conversations, and we do some of the checks and balances But again, I'm loving the aspect of it's just bringing up the next thing to think about, but certainly take what it's saying and model it out with someone who has been in this field.
All right, like do the crystal ball thing. Look out 3 to 5 years. Use AI as your lens. How do you seeing it? How do you see it changing the role of the tax professional 3 to 5 years out? Maybe even quicker. That sounds like forever these days, but call it 1 to 3 years out.
I think it changes what we're looking at, and it pushes the work up the value chain. So we have less time manually compiling files and doing reconciliations. We've got more time designing controls, solving exceptions, and advising on plan design. So I think where it puts us in this opportunity where we could really get the value where it needs to be, and we're helping clients build scalable processes.
Yeah. Do you see it replacing the need for a tax professional? Will there always be human in the loop in your opinion?
I think you're always going to need some human element because there are aspects that the data is good for the AI aspect, running data through and getting certain scenarios, but to really dig into what those scenarios are and having those one-on-one conversations and designing around some of the factors that the tool in and of itself is just not going to know. So I think humans are around for a while.
Yeah, I hope so. I think, obviously we have an AI powered platform. We're using AI for statement ingestion and reading and pulling grant data in and being able to put the grant data in the tool. We're using AI for, the personal assistant. We call it Ask Grant. So you can ask questions along the way. We're using AI agentically to be able to come up with kind of the insights that an advisor or an individual needs to know about their equity comp and even to build strategies for them. So we're definitely, an AI focused company. Having said that, we still believe that a human in the loop, that an advisor is still really important. Not only because of the art and the science coming together, but, money is emotional and, people really want to have that conversation. So sometimes advisors are really good at the science, but maybe even better at like the bedside manner and being able to help them through very, very difficult situations.
Agreed. And look, I think it's a fantastic tool to have for collaborating and partnering with, but there's a lot of what you just said that you have to have that element to pull the trigger and make the right decision.
Yeah, totally. All right, so we're going to do market trends as our double jeopardy today, and then we can close out from there. But what trends are you watching in 2026? We talked about private company liquidity, maybe it's there, or secondary markets. There've been a lot of acquisitions in that space. I just saw Morgan Stanley. Not only did they buy equities in, but they just dropped the pricing in half for secondary trades. But think about plan design, regulatory changes. What trends are you following right now, Joe?
A few big ones. So private company liquidity, more structured secondaries and tender offers. We're seeing more of that. We're seeing more pressure on data integrity between broker and payroll reporting. I think companies are just reached a point of frustration where things aren't aligning and it's causing all sorts of delays and issues along the way. I think continued plan design simplification to reduce the administrative burden. And I think we're seeing a lot more ongoing regulatory attention, especially around cross-border and multi-state compliance. We supported a few companies last year with audits where, the state of New York was subpoenaing cell phone records. Yeah. They want to see that, were you in the state or were you not? And
there's that burner phone thing again.
That's right. And it all ties back. So, the other thing to note is just like, look, tax and the regulatory rules, they could change, especially when we start thinking about internationally. So any trend that we start to home in on, we got to monitor in real time. Things can pivot pretty quick these days.
Awesome. One last question here, and then we can wrap things up. I have some questions for you personally, but before that, if you were giving advice, let's say to 3 different groups, HR or equity comp professionals, financial advisors, and employers with significant equity compensation as part of what they're working with, what would you tell each of those groups?
Yeah, so from experience, I think I mentioned this earlier, it's key that on the corporate side, so an HR typically ends up holding the bag and being the center of this equation, but designing equity programs that are scalable operationally. And what I mean by that is that your payroll department, your equity department, your mobility department, they all have to align and be on the same page. So investing in communications that explains how everything comes together and works for your employees as well. I mean, I often say, set up a communication that explains taxes like you're speaking to a smart person who just doesn't understand this space, is not in this space day to day. So that's the HR comp element. For financial advisors, start with a calendar of taxable events. Build a plan around liquidity, what tax rates might look like, what area of the asset portfolio are certain things concentrated in, and reconcile the forms, especially around cost basis.
Right.
And again, go to their client and say, let's make sure you've got a direct line of communication with HR. For employees, get organized early. Save confirmations, know your key dates. Don't wait until April, and don't wait until April to start asking the tax questions. I mean, these are questions that probably should have been asked back in the fall or some point when the award was initially granted. But if you're waiting until tax season, it's too late. It's way too late.
Awesome. So, Joe, where can people learn more about BDO, especially the Global Employer Services, and a little more about you? How can they get in touch?
Well, I appreciate that question. So if you go to BDO.com, under services, you'll find Global Employer Services. BDO puts a lot of information out, thought leadership, insights around global equity. If anyone has any questions, you can find me on LinkedIn or just email me directly, jpancamo@bdo.com.
And do you, Joe, do you guys at BDO have any like publications or tools for financial advisors that are working with their clients that they can get from those sites, or how do they go about getting those resources?
Absolutely. So if you hit the Global Employer Services page on BDO.com, you will find down at the end of the page links to articles, insights, videos, demonstrations on our global equity mobility solution. Ton of information available for you out there.
All right. So last question. It's summer in February. What's your go-to? All the tax problems in the world were solved today, and it's 2:00, and you get to go outside. What does Joe do?
That's a great question. I am likely sitting poolside. I am likely sitting poolside with a refreshing drink and just relaxing the day away.
I love that. Kick your feet up. You can do one of those pictures where you take a picture of your drink and your toes.
You got it.
Joe, thank you for being part of You've Been Granted. It's a pleasure having you on the call. Your insights are super valuable. This is such an important topic. We decided to have you on in February, kind of to your point, like if you're waiting to April, it's too late. So we wanted to be a signal or a trigger on the tax side of things. And so having you engaged with us has been super helpful. So thank you very much.
It's been my pleasure. I appreciate it.
All right, Joe. See you at Geo maybe.
Sounds good. I'll be there.
All right. See you soon.
Okay. Take care.
Thank you for joining us for this episode. We hope you enjoyed Brian and Joe's conversation. Please stay connected with us on LinkedIn and YouTube for updates on past and upcoming episodes.